Bitcoin isn't just another crypto asset. It sits at the base of the entire system. It's the layer everything else depends on. And when you look past the headlines, what starts to show up is something far less stable than people admit. Beneath the hype and confident narratives, there are real structural issues in the crypto space, issues that rarely get addressed. And that leads to the obvious question, what about Bitcoin itself? Because Bitcoin is different. It's not just one project, it's the foundation everything else is built on. Like the bottom piece in a tall game of Jenga, if it's unstable, everything above it becomes unstable too. And that's what we're going to break down today. The problem is simple. Bitcoin's price is driven by narratives. You've heard them before. That Bitcoin is digital gold, that it's the future of money, that it protects against inflation, against corruption, against the system. These ideas are everywhere. But here's the issue. When you stop listening to the story and start looking at the data, the picture changes. A pattern appears. Every time the technology fails to deliver, the narrative shifts. A new story replaces the old one, and the cycle repeats. So if we want to understand Bitcoin's value, we start with a simpler question. What was it actually meant to be? And this is where things get interesting, because the narratives around Bitcoin aren't random. They're repeated stories that shape how people see it. You've heard them before. And this is where things get interesting, because the narratives around Bitcoin don't just exist, they evolve. Every time Bitcoin fails to deliver, the story changes. What started as a payment system became a store of value. What was meant to replace banks now coexists with them. What was supposed to be used daily turned into something you just hold. And none of that is random. It happens right when the previous narrative stops working. The real question isn't whether these ideas sound convincing. It's why they keep changing. Because the pattern is simple. When reality doesn't match the story adapts. So to actually understand Bitcoin, we have to go back to the beginning. Not what people say it is today, but what it was originally meant to be. Because when Satoshi Nakamoto introduced Bitcoin in the 2008 white paper, the idea was extremely clear. Bitcoin was designed as a peer-to-peer electronic cash system. In simple terms, it was supposed to function as digital money, a decentralized alternative to banks and governments. A system where people could send payments directly to each other without intermediaries, without permission, and without relying on a central authority. And if Bitcoin had actually achieved this, it would have been revolutionary. It would have changed how money moves. It would have redefined trust in financial systems. But there's a problem. It didn't. Not even close. Because when you compare what Bitcoin was supposed to be with how it actually functions today, the gap becomes impossible to ignore. The original vision was simple, a fast, efficient, peer-to-peer payment system. But what we ended up with looks very different. So how do we actually evaluate whether something works as money? Economists usually break it down into three basic functions, three simple tests that any form of money has to pass. First, it needs to function as a medium of exchange, which basically means people have to widely accept it as a way to pay for goods and services. Second, it needs to act as a store of value, something you can hold over time and still expect it to maintain its purchasing power without extreme swings. And third, it needs to function as a unit of account, meaning it has to serve as a standard way to price things so people can compare value across different goods and services. Now, these aren't complicated ideas. They're actually very straightforward, but they matter because if something fails even one of these tests, it struggles to function as real money. And when you start applying these three criteria to Bitcoin, it doesn't just fall short, it fails all of them. So let's start with the first test. Bitcoin as a medium of exchange. Because for something to work as money, people actually need to use it to pay for things. And this is where the problems begin. Bitcoin isn't fast, it isn't cheap, and it isn't efficient. The network processes around 500,000 transactions per day. And that might sound like a lot, but it's not. Because when you compare that to something like Visa, the difference becomes obvious. Visa processes roughly 65,000 transactions every single second, which means Bitcoin's entire daily volume could be handled by Visa in just a few seconds. And it doesn't stop there. A single Bitcoin transaction has a carbon footprint equal to roughly 1.5 million Visa transactions. And in terms of energy, one Bitcoin transaction can use as much electricity as an average American household consumes in over a month. So when you put all of this together, it becomes clear why Bitcoin hasn't been widely adopted for payments. It's simply not a good system for it. So what about Bitcoin as a store of value? At first glance, this argument sounds reasonable. It has a fixed supply, and historically, scarce assets like gold have been used to preserve value. But here's the issue. There are two major problems. First, stability. A store of value needs to hold its purchasing power over time, and Bitcoin has been one of the most volatile assets in the world. It can swing dramatically in short periods, sometimes double digits within a single month. And that level of volatility changes how people treat it. Instead of relying on it, they speculate on it, which defeats the purpose of a store of value entirely. And then there's the second issue, ownership. Because despite the idea that Bitcoin is decentralized, the actual distribution is highly concentrated. A small percentage of addresses controls the majority of the supply. And when ownership looks like that, it means price movements can be influenced by a relatively small group of large holders, which makes the system even less stable. So when you combine volatility with concentrated ownership, the argument for Bitcoin as a reliable store of value starts to fall apart. So, what about the third test? Bitcoin as a unit of account. Because for something to function as real money, it needs to be used to price goods and services. It has to act as a standard measure of value. But Bitcoin doesn't do that. Even businesses that accept Bitcoin don't actually price anything in Bitcoin. They set prices in traditional currencies and then convert that amount into Bitcoin at the moment of payment, which means Bitcoin isn't being used as the reference point for value. It's just passing through the transaction. And that's a problem, because if something isn't being used to measure value, it can't function as a true unit of account. And at this point, I already know the response that's coming. Well, we just haven't given it enough time. And to that, I'd say we actually did, because this isn't just theory anymore. We've already seen what happens when people try to use Bitcoin as a real currency. We don't have to assume. We already ran the experiment. And the results tell us a lot. Because back in 2021, El Salvador became the first country in the world to adopt Bitcoin as legal tender. The government launched a national wallet, required businesses to accept it, and even gave citizens $30 worth of free Bitcoin to encourage adoption. This was the moment, the real-world test, the point where Bitcoin finally had the chance to prove it could function as an actual currency. And the results were a failure, because according to IMF data, Bitcoin made up less than 2% of remittances. Even after incentives, legal backing, and years of promotion, the vast majority of people still chose traditional financial systems. And it gets worse. Millions downloaded the government wallet, but most of them only did it to claim the free $30 and then never used it again. So when people finally had the option to use Bitcoin in real life, they didn't. And that tells you everything. Which brings us to the final question. If Bitcoin doesn't work well as a medium of exchange, doesn't hold up as a store of value, and doesn't function as a unit of account, then where does its value actually come from? Because when you strip away the narratives, remove the marketing, and ignore the hype, what you're left with is a very old concept in finance, the greater fool theory. The idea that an asset's price doesn't need to be justified by real utility as long as there's someone else willing to buy it later for a higher price. And when you look at Bitcoin through that lens, things start to make more sense. It doesn't generate cash flow like a stock. It doesn't produce anything like a commodity, and it has very limited real-world utility. Its price is driven by belief, by demand, created from the expectation that someone else will pay more. And as that demand grows, the price rises, attracting more buyers, and the cycle repeats. So every narrative you hear serves a purpose, to bring in new buyers, because the moment that flow stops, the system breaks. And that's the uncomfortable reality. Bitcoin is sustained by belief, and eventually that belief runs out.